Your business is bleeding, and most owners don't even realize it yet. Interest rates have been sitting at levels we haven't seen since the early 2000s, and the investors who used to throw money at every pitch deck are suddenly very hard to find. Let's back up and understand why we got here, because this didn't happen overnight. The Federal Reserve raised rates 14 times between 2022 and 2023, and that singular chain of decisions quietly rewired the entire economy around you. Think of cheap money like oxygen in the room when there's plenty of it. Everybody breathes easy, expands fast, and takes risks without thinking twice. When the Fed started draining that oxygen, businesses that were built on borrowed fuel suddenly found themselves gasping at the worst possible moment. Just 2 years ago, headlines were screaming about a golden era of entrepreneurship. Venture capital was at all-time highs, and small business optimism indexes were practically euphoric. Now, those same publications are running stories about funding winters, zombie startups, and the death of the growth at all costs era, and the whiplash is genuinely disorienting. The psychological toll of watching investor sentiment reverse this fast is something nobody prepares you for in business school. One founder told Forbes she felt like she trained for a marathon only to show up and find out the race was now a swim meet, the rules changed, and nobody sent a memo. Here's the thing history keeps trying to teach us though. We have absolutely been here before. The 1994 rate shock, the 2006 credit tightening, the 2018 Fed pivot, each time felt catastrophically unique. And each time the fundamentals eventually reasserted themselves. Statistically, businesses with debt-to-revenue ratios above 40% are the first casualties in a high-rate environment. And right now that describes roughly 1 in 3 small businesses in America. But here's the absurd irony. The businesses that survive these contractions almost always come out with stronger margins, leaner operations, and less competition breathing down their necks. A common misconception is that high rates simply mean nobody is investing. That's actually not true. And it matters enormously that you understand the difference. Capital doesn't disappear. It just gets more selective, which means if your fundamentals are strong, you're not competing against 40 mediocre pitches anymore. You're competing against 4 serious ones. The practical lesson hiding inside every historical rate cycle is almost embarrassingly simple. Reduce variable rate exposure, extend your cash runway, and do not mistake a slow quarter for a structural failure. Businesses that confuse a cyclical headwind with an existential crisis make permanent decisions based on temporary conditions, and that is how otherwise healthy companies die. Position sizing matters here just like it does in any investment. Don't overextend into new hires, new leases, or new product lines until your cost of capital is clear and your receivables are predictable. Discipline in slow markets is exactly what creates the capacity to move aggressively when the tide turns. And it always eventually turns. There's almost something philosophically clarifying about a high-rate environment because it strips away all the noise and forces you to answer one honest question: does this business actually work? Or was it only working because money was free? The ones that answer yes to the first part don't just survive the cycle, they define the next one. If you're sitting there wondering whether to hold your position or pivot, here's the cold comfort of pattern recognition. Every contraction in investor appetite in modern history has been followed by a wave of deployment into businesses that kept their operations clean during the drought. You don't have to love this environment. You just have to be prepared enough to still be standing when it ends. Comfort with uncertainty is not resignation. It's actually the most competitive posture you can hold right now while everyone else is paralyzed or panicking. Rational preparation, boring as it sounds, is the actual edge in a market where emotion is making most of the decisions. Discipline, sizing, and consistency aren't just investing principles. They are the entire operating philosophy of every business that has ever navigated a cycle like this one and come out the other side intact. You don't need perfect timing. You need a process that works even when the environment doesn't cooperate. Whether you're trying to protect what you've built, restructure your financing, or find the right capital partner for what's next, we can help you get started in real estate investing, home contracting work, and finding lenders. Check out our links in the description below.